The markets did not like when CPI inflation came out on Wednesday because it missed Wall Street estimates. But what's everyone missing here? Housing inflation. Housing contributes over 1/3 of the CPI inflation calculation and has contributed to over 70% of inflation this year. Now, CPI uses rental costs as a proxy for housing inflation, and what's been driving rents up? Well, a big chunk of that is mortgage costs. If you have a rental property with a 7.8% mortgage on it, the current average in the US, then you're going to demand a higher amount for rent than if it was, say, 2 or 3 years ago when your mortgage costs would have been like 1/3 of that. So when interest rate futures shot up, implying a much greater likelihood of future rate hikes by the Fed, it kind of misses the point. You can't use high housing costs as an excuse to keep raising interest rates when those high housing costs are in fact a direct function of already high interest rates. The punchline here is that the Fed isn't oblivious to this, and investors need to focus on sources of inflation elsewhere, like food or energy, in order to get a better gauge of where the economy is headed.